Hello students, today we are going to discuss a short topic on working capital. So if you see working capital basics, we know that if we define the working capital involves the managing a firm's short-term assets and short-term liabilities. So in other words, we have two parts in working capital, current assets and current liabilities. So we need to manage these two major aspects. So that is called managing the working capital. So if we subtract the current liabilities from current assets, what do we get? We get net working capital. So net working capital is the difference between current assets and current liabilities. So if let's see if the working capital is, if the current assets are higher than current liabilities, what will happen? That it means that we have higher liquidity. Let's say current assets are 120, current liabilities that we need to pay are 100, our difference would be 20. So it means 20 these 20 assets are actually the current assets. So these are the short-term funds that the company has, and these are liquid because these can be used to manage the liquidity. So higher the net working capital, higher would be the liquidity of the company. Company can sell it and can use these current assets. Okay, so there is a threshold. If the working capital is equal to 1, so it means company can easily meet its short-term liquidity, and if it is 1.2, we can say that the company is keeping a good liquidity and it is efficiently using its short-term assets. And if the working capital is greater than or equal to 3, so it means that we have more current assets than the current liabilities. So those funds are actually idle. The company is not utilizing those funds efficiently. So it means that these funds might be logged in receivables and inventory. So higher net working capital does not always mean that company is, though the company might have a good liquidity, but these funds could be used for some other purposes, for other investment purposes. Okay, so net working capital is the difference between current assets and current liabilities, and the management of current assets and current liabilities is very important. So but what if working capital is negative? It means that our current assets are 100 and current liabilities are 120. So it means that we have 20 negative. In other words, company has a reduced liquidity. Liquidity means if anything happens, company cannot meet the short-term obligations. So this can lead to some insolvency risk. In other words, company can go bankrupt. So this is very dangerous situation if the company has more current liabilities than the current assets. So that is why managing the working capital is a crucial part in finance. Okay, this is also reflected if you see what is the problem, why is it important to manage the working capital? Because short-term cash inflows account receivable and outflows like account payables, they might have a different timings. Maybe if a company takes some assets on credit, and they might take a inventory on a credit on 60 days basis and receivables are received in 90 days, so that the difference of this period actually creates a problem. So that is why it is very important to have a good management of the working capital. So if you see this line, it says that short-term investment, short-term cash inflows and outflows do not always match in their magnitude and time. So time could be different, magnitude could also be different. We have borrowed more and maybe our sale was not higher, so it could be the magnitude, thus creating a need to change the working capital account. So of course that is why the company needs to balance this working capital. Another thing, trade-off mean if the company keeps more working capital, as I just told you, it is good for the company, that company has more liquidity, but at the same time there is a trade-off that the company may lose an investment opportunity and company could also use those funds for some other purposes. So it means holding the higher level of cash could be costly for the company. Okay, so that is actually a trade-off that the managers they have to do. Now to understand the cash and operating cycle for a firm, so these are two actually parts of the working capital. We call them as cash and operating cycle of a firm. So operating cycle is a broader term, cash is relatively a shorter term. It is cash is also called net operating cycle and this is operating cycle. So what is operating cycle for a firm? So company can manage working capital through this cycle. First of all is the operating cycle. Operating cycle means the time the company purchases the inventory to the point that the company actually receives back the cash. Okay, so this is a point where the company gets the inventory. During this time the company will sell it and then company will receive the cash from its sale. So if you see the average length of the time between when a firm originally purchases the inventory and when it receives the cash from selling its product. So from the supplier the company would buy some inventory, so company will sell it. So let's say company is selling it at this point and now let's see company is selling it on credit. So it will take some time for the company to receive back the cash. So this whole time period is called operating cycle. Okay, so cash conversion cycle is actually a time or the length of the time between when the firm pays back to this supplier, or in other words when the firm pays cash to the purchase the time when the firm pays cash to purchase its initial inventory and the time when it receives its cash from the sale of output produced from the inventory. So it's a very simple process. We will actually, so if you see there are three phases. Number one, this is inventory phase. This is also inventory phase, but here the company is selling. So during this period the company will create account payable, company will pay to the supplier and company will sell those inventories to the customers and this will generate account receivable. So account receivable part is here. Okay, so once this is the period where the customer of the company will pay back the cash. Okay, so it means the time between the company pays cash to the supplier and receives cash from the debtors. So this is actually cash conversion cycle. So in other words, shorter this cash conversion cycle, better it would be for the company. That it means that the company is efficiently managing its working capital. So we will understand this cash conversion and operating cycle in next slide. So that is very easy. So there is a graph I can explain. Okay, if you see this graph, this is actually firm buys the inventory from the supplier. Okay, so here account payable has been generated. As you can see, this is account payable. So here the company firm pays for the inventory and after that company is going to sell this inventory to the customer. So firm sells the product and then it creates account receivable. So once the account receivable is created, these customers will pay back the cash to the company. Okay, so this whole cycle from the time where the company purchases the inventory to the time when the customers they pay back the cash, this is called operating cycle. But cash conversion cycle is a cycle which actually starts from the time when the company pays to the investor. So it will start from here. Okay, to a point where they receive the inflows. Okay, so this is an outflow and this is an outflow, inflow and outflow. The difference between this outflow to the supplier and the time between the outflow to the supplier um, to the time when the when the customers they pay back the cash. So this is called cash conversion cycle. So in other words, if we have operating cycle and if we subtract the account receivable, we can get cash cycle. So this is called cash conversion cycle. In other words, this is also called net operating cycle. Okay, so you should understand the difference between operating cycle and cash conversion cycle. Operating cycle is the time when the company buys. Okay, so it should start from buy to the point when the company receives the cash. So this is operating cycle. What is cash conversion cycle? Cash conversion cycle is when the company pays, when company start paying to the suppliers to a point when the company start receiving the cash from the customers. Okay, so this is actually the graphical depiction of cash and operating cycle, and we also call cash cycle as net operating cycle. Why net? Because from this total operating cycle we are subtracting account payable. So we can also call it that this inventory is there sorry, inventory is there, and from sells the inventory is there. So these days are called inventory days, and this is account receivable days. Okay, so if we see, we can also write operating cycle as like that. Inventory days mean when the company buys the inventories and sells the inventories, so that is actually the inventory days plus account receivable. So that is called operating cycle. How about cash conversion cycle? We have operating cycle minus account receivable. Once we get this operating cycle, if we subtract account payable, we get cash conversion cycle. In days, if we want to write it in days, operating cycle is called inventory days plus account receivable days minus account payable days. So it means these 2 days, so they are referring to the inventory days. Okay, or in other words, these are operating cycle. So this is operating cycle minus account payable. So it will give us cash conversion cycle. So we will see how to measure that inventory days. Inventory days mean okay, inventory days is inventory divided by average daily cost of goods sold. In other words, how many days a company keeps in inventory before converting into sale. Okay, so how many days does this inventory uh, uh, is kept in the company? So that is called inventory days. So if the inventory days is higher, so it means this is not a good sign. Inventory days should be shorter, mean the company should immediately convert this inventory into sale. Account receivable days means account receivable divided by average daily sales. In other words, it says that how many days does it take to the company to collect back the receivable. Okay, so if the company is able to pay to receive the account receivable or cash from the customers very quickly, so that is a good sign. Account payable days mean, if account payable divided by average daily cost of goods sold, mean how many days company takes to pay back to the suppliers. Okay, so we will take these, we will calculate cash conversion cycle or operating cycle through these through these heads. You will see that in the next example. Okay, so the example says that the Greek connection had sale of 32 sale is given in 2013 and cost of goods sold of 20 million. CGS is given, sale is given, so we will see that we will use this sale as well as we will use this CGS in the formulas. Okay, a simplified balance sheet for the firm appears below. So we are given assets, we are given liabilities and equities. So first of all we have cash, that is current assets. The total current assets are 7250. So these are the liquid assets. And what are the current liabilities? So total current liabilities are 3720. Okay, so let's see what the question requires us to do. First of all, the question asks us calculate the Greek connections net working capital in 2013. So we know that net working capital is equal to current assets minus current liabilities. So how to find current assets from the balance sheet and current liabilities from the balance sheet? So if you see, the current assets are 7250 and current liabilities are 3720. So if you see the difference is positive, so it means the company is managing a good liquidity. Company has more current assets than current liabilities. So if you see, the answer is positive, so it means company has a positive liquidity. So after that, let's see how is the company managing the working capital through operating and cash conversion cycle. So B part says calculate the operating cycle and cash conversion cycle of the Greek connection in 2013. So as we know, we had learned three parts: inventory days outstanding, account receivable and account payable. So once we understand this, it will be easy to calculate. So these two parts, they are part of inventory, and this is the part that is payable. Okay, so let's do inventory days outstanding. So it is equal to inventory divided by cost of goods sold. When I say average, so it means we are doing it 365 because it will give us our answer in days. Okay, so inventory in the balance sheet is given. How much is the inventory? 1300. Okay, and cost of goods sold is already given, so that is 20. Okay, so this is inventory, this is cost of goods sold divided by 365 because we want the answer in days, so that is 23.73 days. So inventory stays in the company for 23.73 days. Account receivable mean how many days does it take to the company to collect back the cash. So is equal to account receivable divided by sale. Sale we are already given, that is 32. Account receivable we should get it from the balance sheet, so that is 3950. So if you see, our answer would be 395 divided by sale, that is 32 already given, divided by 365, so that is called the average sale. So answer would be 45 days. Okay, and now let's calculate the account payable. Account payable is account payable days mean account payable divided by CGS. CGS we are already given, so this is given already. Account payable we will calculate. In that we will only include only account payable, not notes payable. Okay, notes payable are relatively different than account payable, so we will be using only account payable. So account payable divided by sale divided by CGS divided by 365, so 27.38. So it means the company is receiving the cash in 45.05 days but paying early. You see, company is paying early but receiving late, so there is a difference. Okay, so there is a difference. This difference should be managed. So what is the operating cycle? Operating cycle is inventory days plus account receivable, that is operating cycle. Okay, so it is actually the time where the company borrows the inventory and the time when the company collects the cash. Once we get it, so this is operating cycle, and then we subtract account payable, so our answer is 41.4 days. So cash conversion cycle is 41.4 days. So what does it mean? So we can explain it from here. Okay, high inventory days mean would focus a manager on why the firm needs to have its inventory on hand so long before it sells the product. It means if the company is holding the inventory for higher days, so that is not a good sign. Company should reduce this high inventory days. High account receivable days, as we can see, account receivable days are 45, so it should be reduced, because the quicker we get our cash back, it would be better to get the cash back. Okay, so it may signal that the firm is having trouble collecting the funds from its customer. If account receivable pays days are higher, this is not a good sign, and if it is inventory sign is also higher, that is not a good sign. So it means these two periods are very long. So in other words, the firm's operating cycle is really long. Okay, so now let's see low account payable compared to inventory and receivable. As we can see we have lowest account payable days. Okay, so it means we are quickly paying to the suppliers, so that is not a good sign. So if it is lower, if account payable time is lower, so that is not a good sign. We should be able to make full use of the credit term, and we should not pay it early. So that is why our cash conversion cycle is positive, so that is not a good sign. So it indicates that on average the company pays its supplier 41.4 days before it receives cash from its customer. Okay, so as you can see from cash conversion cycle, so company actually this includes inventory as well as receivable. So it takes total sale and it takes total payment. So it means company is paying very early than when it receives the cash. Okay, so it should be lower, or it should be, if it is negative then it is very good. Okay, so if the cash conversion cycle is negative, then it means that the company receives cash from its customer earlier than when it pays to the suppliers. So higher cash conversion cycle is not a good sign. So it means that the company has paid to the debt holders first. Now a company hasn't received anything from its customers. So what to do? Company would need more external finance to fund the shortfall. Okay. Next is managing working capital accounts. So how to manage these accounts then? So we will talk head by head. So first of all, we need to maintain minimal raw material inventories without causing manufacturing delays. So it means when the company buys the inventory, the company should be very careful that the company should not keep higher level of inventories. So it should keep a balanced level of inventories, so that there are no manufacturing delays, so that it does not stay longer in the store. So maintain minimal finished good inventories without losing sale. So it means that we should convert this inventory very quickly into sale. Offer customers the most attractive credit terms possible on trade credit to maximize sale, while minimizing the cost of this credit, finance, and the risk of non-payment. So it means the company should give very easy or very flexible or very good credit term to the customer, so that they pay it, give them some if some benefits, like if they pay less than 30 days, they will get let's say 1% discount. Okay, so they should offer these credit terms to the customers so that they can receive it earlier and pay to the suppliers. Collect cash payment on account receivable as fast as possible to close the loop. So this is actually the same thing. Delay paying payable as long as possible without suffering any penalties. It means that if the company has taken inventories for 60 days, so we should make a full use of 60 days. So we should keep delaying the payment to the suppliers. We should make the full use of 60 days. We should not be paying it on 55th day or 59th day. So we should use full make. So we should not be paying it on 61st day as well, because if we exceed the time, so we will pay a penalty. Okay, if a firm's need to hold cash is reduced, it it means that if the company is holding less cash, the funds can be invested in a number of different short-term securities. So this way, if we maintain lower level of inventories we are very quick in getting our account receivables and we are very late in paying the funds to the uh, suppliers, then we can save those funds and that can be invested somewhere. Okay, so with the finance manager's objective to maximize the value of the shareholder, each of the decision above, all of these decision should be made to shorten the cash conversion cycle, okay, and improve the company's liquidity. So it means that we should reduce the cash conversion cycle. So when this cycle would be reduced, so it means that we are managing our net working capital quite efficiently. So that is why this is the need of managing the working capital. So now as we see firm value and working capital, as we see that if our cash conversion cycle is lower, so we can save some funds and we can improve the value of the firm. So this is, of course, there is a relationship between firm value and working capital. So any reduction in working capital requirements generates a positive free cash flow, okay, that the firm can distribute immediately to shareholders. So it means company can distribute that to the shareholders and also company can use it to invest somewhere. This is because the fund tied up in the working capital can be deployed elsewhere in the firm to earn a return. So in other words, if our cash current assets are very high than current liabilities, so it means though we have liquidity but we are not making the full use of that funds, okay. Managing working capital efficiently will increase those free cash flows, allowing managers to maximize value, and we will see a question on this part. Okay, let's take an example, the relationship between the value of the firm and working capital. The project net income and free cash flow next year for the Emerald City Paints are given in the following table in 1000. So this is the net income. We add back depreciation. What do we get? We get cash flow actually, but we have to also adjust capital expenditure. We have increase in working capital. Working capital were increased. So when our working capital have increased, it means we have made an outflow. So outflow is always negative here. So our free cash flow is 1900. So because when we calculate the value of the firm, we do CF divided by R, right? So that is why they have given us free cash flow. So it means we can use this free cash flow here to get the value. So let's see if we change this working capital, how much effect would it give to value of the firm. Okay, so it means this is the formula that we use, CF divided by R for the company. So company expects capital expenditure and depreciation to continue to offset each other, means they will offset each other, no problem, for both net income and increase in working capital to grow at 4% per year. So the company is saying that this working capital will grow at the rate of 4% every year. So growth is 4%. Emerald cost of capital is 12%, this R is 12%. If the company is able to reduce its annual increase in working capital by 20%. So now we have a working capital of 1000 and now company is able to reduce the working capital by 20,000, okay, by managing its working capital more efficiently without adversely affecting any other part of the business. What would be the effect on the company's value? So in other words, there will be a growth in the working capital, but working capital needs every year would be 20% less. Okay, so now we have working capital of 1000. Next year our working capital would reduce by 4%, but they will also grow at 4%. Okay, so our working capital need would be lower, will reduce by 20%, but there is a growth as well of 4%. Okay, so let's see how to solve this question. A 20% decrease in working capital mean 1000, so 20% decrease would give us 800. Okay, so would reduce the starting point from 1 million to 800,000, because it was given in million, so I use 1000. The working capital increase would still grow. It will grow. It is not like it is not growing, but our requirement is low. But each increase would then be 20% smaller than the last time. Okay, so we can calculate the value of the company, because value of the company is equal to CF divided by R, because it is for the next year, so we cannot do 1 plus G. Cash flow is already saying that it is next year. So since growth is given, we will do R minus G. Okay, so now let's calculate our value of the firm. So if you see in the previous question, we have 20,000, 5,000, 5,000, 1,000 and then 19,000. Now in this case our cash flow was 19,000, but now let's say if our cash flow is instead of 1,000 we will have 800 or 800,000. So what would be our answer? So these will offset each other as it is mentioned already. So these will be offset. So instead of 1 million, our working capital would reduce to 800,000. So 4% is the growth rate. Our answer would be 240. So if you see the value of the company by managing the working capital from 1 million to 800,000, we can increase the value of our company from 237 to 240. So as you can see, there is a direct link between the working capital management and the value of the company. Now in this section, we are going to discuss some strategies for the working capital. So there are basically three strategies we will look at. Number one is aggressive approach, then conservative approach, and then moderate approach. Okay, so these strategies are based on the risk level of the finance manager. So we need to decide how much risk taker or risk averse is this finance manager. So it is based on the type of financing he uses, to buy the assets. Okay, so as you can see, first of all, from the matching principle says that you need to buy the fixed asset using the long-term funds and current assets using the short-term funds. Okay, so and also if you see in the next part, there are two types of working capital: permanent working capital, so they are long-term current assets, and temporary working capital, they are seasonal or short-term. So it means these are the current assets, but you have to maintain it. So this is the minimum level that you need to maintain every year. And seasonal or short-term are the temporary. So this is temporary working capital, and so this is a long-term working capital. Okay, so if you see this part of this lecture, so if you're using the long-term funds to buy the fixed assets mean your machinery, equipment, plant, then it means the matching is followed. Okay, and if you are using the long-term funds to buy permanent working capital, and you know that this permanent working capital is of long-term nature, so then in this case as well we are following matching principle. And if you are using short-term funds to buy temporary working capital, again the matching is also followed. But in situations where you use this short-term fund to buy permanent working capital, in this situation matching is not followed. Okay, or if you are using long-term funds to buy short-term or temporary working capital, matching is also not followed here. Okay, so this is the approach that this finance manager has to decide. If he is we need to see whether he is following the full matching, or is he using the mix of matching. Okay, for instance, we will see that in these approaches he is using short-term funds to buy long-term funds and long-term funds to buy short-term funds. But please remember that before we discuss further, if you are a manager and you are taking the short-term funds, okay, short-term funds to meet your need of temporary working capital, then it is okay, because you are matching it, and because this is a short-term need, so you are fulfilling your need using the short-term funds. Okay, if you are also using short-term funds to buy the permanent working capital, it means that you are risk taker. Okay, So risk taker means that let's say this need for permanent working capital, we need it for 5 years, and it is perpetual normally, but you are using the loan for 1 year every year to buy the permanent working capital, and next year you take another loan to buy permanent working capital. So you are taking loan every year to meet your long-term needs. Okay, so it may happen that maybe after 1 year, the rate at the first year, let's say you got the rate at 10%. Okay, next year it could happen that maybe the rate is higher, it is 12%. Okay, or maybe in next year it could be even higher, or maybe it is possible that you are not able to finance it. Okay, you are not able to finance it, it could be possibility. But if you look at the situation of taking a long-term loan, so you have taken a loan, you don't need to take loan every year for different years, so it's all okay. But if you are using the short-term funds every year, refinancing it, there is a chance that the cost or refinancing may increase. Okay, but we will see that if you are taking short-term loan, short-term funds, and we have long-term funds, so the cost of short-term fund is always higher than the cost of long-term funds, but the total cost of the short-term funds, if you keep using that every year, or maybe some years you don't need it, right, the overall cost, total, or I say overall cost, will be very low. But in this situation, since you have committed this loan, so maybe it is happening that this year you need working capital, so it's okay. Maybe next year you don't need that, but since you have already taken a loan, so you will also have to pay the cost of this period. Okay, so it means that though the cost of borrowing of the long-term financing is lower than the short-term financing, but you also pay the cost for those periods where you are not actually using the loan, right? But short-term funds, every year the cost is higher, but you are actually skipping those years where you are not using your funds. Okay, so what is the benefit? So let's say if I take the short-term funds, so cost is higher, but you can save in periods where you don't need funds. Okay, and long-term loans, cost is lower, but you have to pay in periods where you're actually not using that. Okay, so if a manager is following the short-term funds approach to buy long-term funds, so we will see that what kind of approach he is following. And if you see aggressive approach, in the aggressive approach, the manager is using the short-term funds to buy short-term funds, temporary working capital, as well as he is fulfilling his permanent working capital need through short-term funds. It means that he is financing every year, new financing every year to cut overall cost. Overall cost means he will not use some years where he doesn't need the financing, though individual years cost is higher, but he can save some payment in terms of financing cost if he is using short-term funds. Now, if you look at this diagram, so short-term funds, long-term funds are being used to buy fixed assets, matching is there. Long-term funds to buy permanent working capital, matching we are following. Short-term funds we are using to buy temporary working capital, matching is followed. If you're using short-term funds to buy permanent working capital, matching is not followed. Okay, so the same thing is reflected in this table. So the source is that you are buying this fixed asset using this long-term fund, matchings yes, and the permanent working capital, if you're using just long-term funds to buy permanent working capital, matching should be followed, but you are also using some short-term funds. So matching is violated. And temporary working capital, you're using short-term funds to buy temporary working capital, matching is followed. So overall, you are not match. Overall, if I talk of overall, matching is not followed. Okay. But what is the benefit? The benefit is that the liquidity is very low. Mean if you are financing every year and you are not using, and every year it's a new financing, so level of cash, for instance, is very low. Okay, so it is, the liquidity is very low. Liquidity means how quickly you are able to pay back your liabilities. Okay, so for instance, you need to pay your liabilities, you have to take a loan. The cash is not readily available because you have not taken long-term loan. Okay, if you take long-term loan, you have some cash available to you, so you can pay. And profitability is high because you remember this part, for some period you are saving your financing costs, so profitability will be higher. But there is a financing risk, so I'm calling it as refinancing risk. So this year you took loan, second year you took loan, maybe third year the situation is not good, the economy is not doing well, so it could happen that there is some financing risk. Okay, so this is the aggressive approach, and we can also show it graphically. So this is non-current assets. Non-current assets mean fixed asset. Okay, so fixed asset, this you are buying through long-term funds, fixed asset. Okay, so from here to here is permanent working capital. So permanent working capital mean you are also using some long-term funds to buy this much of permanent working capital, and this is temporary working capital. Okay, some temporary working capital mean the need is you are increasing your working capital, and in this year you don't need that. Next year you also follow, you have higher need for the temporary working capital. Next, this year, this period you don't need that, and then you can see that there is a fluctuation. But if you see, if you are using the short-term funds to buy this part of the permanent working capital, so this is being bought through short-term financing. Okay, so this is temporary working capital, you're using short-term funds to buy that, but you're also using some short-term funds to buy some permanent working capital. So that is why, so matching, but in this part the matching is there, but you will see that short-term funds are also being used to buy the permanent working capital, so it is violated. So assets are on this side and this is time. Now formula is long-term financing is used to buy the non-current assets in fixed asset plus portion of permanent working capital, and short-term financing portion of permanent working capital plus mean permanent working capital plus temporary working capital. Okay, so matching, no matching. Next, in the conservative or approach or risk averse approach, the manager does not want to take the short-term financing every year. He in fact takes the long-term loan to buy the permanent working capital. Now, if you first look at this diagram, so long-term funds are being used to buy the fixed assets. Matching is followed. Long-term funds are used to buy permanent working capital, matching. But if you see, this long-term fund is also being used to buy some short-term funds, temporary working capital. So it means the company is using long-term funds to buy temporary working capital and short-term funds to buy temporary working capital. Okay, so previously the manager was not taking long-term loan, he was taking short-term financing to buy the permanent working capital. In this situation, the manager is using long-term funds to purchase temporary working capital as well as permanent working capital. Okay, So since he is using long-term funds, he doesn't want any risk of refinancing. He wants to keep liquidity high. He wants to, though the profitability will be lower, and for refinancing, the risk will also be lower. Okay. So if you see long-term funds to buy fixed asset, long-term funds to buy permanent working capital, matching, and matching is violated here. Okay. Long-term funds plus short-term funds to buy temporary working capital. Similarly, we can also show it on the graph. Okay, long-term funds, so they are being used. Okay, and these are fixed asset, and long-term funds are used to buy this one. And long-term fund is also used to buy, if you see, this part of working capital as well, right? It means that temporary working capital is also being bought with some part of the long-term funds. Okay, so this is actually long-term fund is being used to buy some part of temporary working capital. Okay, so this is permanent working capital, not this one, and also it is this fund. These funds are used to buy some temporary working capital. And if you look at the formula, the formula is missing, so no issues. Yeah, this is the formula. Okay, so long-term financing is used to buy non-current assets, mean fixed asset, plus permanent working capital, plus some part of temporary working capital, and short-term funds are used to buy short-term only. Okay, the last approach is a very balanced approach. It is a matching approach, mean we are using long-term funds to buy long-term assets and short-term funds to buy short-term assets. So short-term financings to buy temporary working capital, long-term funds for permanent working capital and fixed assets. Okay, so matching is followed in all possible investments. Okay, so matching long-term funds, yes, long-term funds for the working capital, yes, and short-term funds for the working capital, temporary working capital, yes. And the liquidity will be medium, and medium. And we can show it through this graph. Okay, so as you can see, non-current assets through the long-term funds, the permanent working capital through the long-term funds, and short-term funds for the temporary working capital. So these are the three approaches that we should remember. Now in this section, we are going to discuss the components of working capital. We learned that there are different components of the working capital, like account receivable, right? Account payable, inventory. So we need to discuss these components separately in next few slides. Now, first of all, to understand the different components, we need to see what is trade credit. Trade credit is normally given by the seller. The purpose of giving the credit sale to customer is to increase sales, right? So let's say if someone is only selling things on cash, the sale level will be very low. But if it also offers some credit, the sales will increase. Okay, so that is why that is the purpose of extending the sales on credit. So when the suppliers, they write their credit terms, they have a different way to write it. That is 2, 10, and 30. Net 30 means the total duration for the credit is 30 days. But if you want to pay it in 10 days, the customer will get a discount of 2%. So just look at this timeline. So total duration is 30 days. The purchase is made 100. So if you pay in 10 days, you're going to discount of 2%. So it means you are going to pay 98. And if you don't want to pay it on 10th day, you have to pay how much? 100. So this is how we write trade credit terms, like to 10 and 30, net 30. Okay, so this is, if you read this, if you find this, you know how to interpret that.
Now let's understand the effective cost of trade credit. Effective cost of trade credit, it's similar when we talk about effective annual rate. So we need to understand this. Okay. So first of all, your firm purchases goods from its supplier on terms of 115 net 40, mean 0 to 40 is the total period. 0 to 40 is the total period. And 115 means if you are going to pay in 15 days, you are going to get a discount of 1%. So 1% of 100 is 1. So it means on 15th day, you can pay 99. But if you are not going to pay on 15th day, then what will happen? That you will pay dollar 100. So as a finance manager, you need to decide. You need to decide means you have to think whether you should pay 99 on 15th day to get $1 saving, or you should use this 99 for the remaining uh, how many days? 25 days. Okay, so this is the decision you need to do: pay or use what? 99. You cannot say 100 because this is an offer that is there, so you need to evaluate this offer, not 100. Okay, so pay or use. So let's say uh, if you pay it means you will get a return of $1, and this return means I will say that this return is a return for how many days? For 25 days. So this is the return, that is, you have received this return for not using 99 for remaining 25 days. In other words, so this is return for 25 days. So if I talk about this return in 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 percentage terms, so I will say $1 divided by 99. So answer is 1.01%. So it means 1.01% is the return for how many days? 25 days. Okay, so this is the return, but this is for 25 days and we need to convert it for annual rate. But before we do that, you need to understand that. So let's say you are thinking to pay. Okay, you are thinking to pay. Since you have already taken the credit sale, let's say you don't have cash. So what you can do is you can borrow. You can borrow from a bank. Okay, so you will borrow, let's say 99 from a bank. So you, after getting the cash, you will pay 99. Okay, so after the borrowing period is over, so let's say for 25 days, so what are you going to do? You will pay 99 to bank, plus you will also pay some interest payment. Okay, so this is you need to pay, right, when the borrowing period is over. But why are you thinking to pay now? Because you know that you can borrow from a bank at a lower cost, so that you can save. So lower cost means that when you're going to pay to the bank, the cost will be lower than what you are going to get from the credit policy. Okay, so it means that the cost should be lower. The cost that you're going to pay to the bank should be lower than the return that you are going to get from that discount. So this is we need to decide. Okay, but since this the banks, they do not give you loan for 1 year, right? They cannot give you loan for 25 days. This is not a normal practice. They give you loan for 1 year. So that is why we have to convert this return into a yearly return. Okay, So this is what we have done here. So how can we do that? We can do effective annual rate is equal to 1 plus r power m minus 1. So to calculate this m, because the period is in days, so how many days in a year? 365. But this return that you are going to use here is for how many days? 25 days. So how many times we observe 25 days in a year? 26, 14.6 times. So it means 14.6 times we observe how much? How many days? 25 days. Or in other words, 25 days come how many times? 14.6 times. Okay. So then we need to use this rate. This rate, how did we get it? 1 plus 1 divided by 99. Okay, power 14.6 minus 1. The answer is 15.8%. The answer is 15.8%. So it means that if you convert this 25th day's return of 1.01%, 1.01% into yearly rate, that becomes equal to 15.8. So this is an annual rate. So if you're able to secure a loan of 99 from a bank that is lower than 15.8%, so let's say if it is 14%, so will you take the credit? Yes, you are going to take the credit because your return is higher than the cost that you will pay to the bank. If it is 16%, so you will better use the 99 for the remaining 25 days. You will pay at the end how much? 100. So this is actually the effective cost of trade credit that we need to understand. Now, to decide the receivable management or the credit policy, there are some factors that the company must know. I mean, when the company determines the credit policy, the company must determine the credit standards, credit terms, collection policy. Credit standards mean that does the credit applies to all the company, or it is only those customers who have a very low credit score or who have good reputation. So what type of customers will be included in this credit policy of the company? The company needs to decide. And establishing the credit terms, this is what we have done: 2 by 10 and 30, 1 by 15 and 40. These are the terms that the company needs to decide. And establishing a collection policy. So when the account receivable is generated, how are the collections going to be? Like, uh, let's say if the customers are not able to pay it on time, what is the action the company uh, is required to do? A legal notice or short reminder, or sorry, a very soft reminder, or what? So this is uh, this should be part of the policy when the company is doing the it's making credit policy. And then these are 5 C's of customers when the company is evaluating their position to extend credit policy. Number 1 is the character. Character means that is the borrower trustworthy with a history of meeting its debt obligation. Okay, well, I mean good reputation. Capacity, in other words, it means that will the borrower have enough cash flow to make its payment? Okay, how is the sale position? How is the cash flow position? Capital mean, does the borrower have enough capital to justify the loan? Mean the size or assets of the company. Collateral mean, does the borrower have any asset that can be secured as a loan? So let's say mean as a security. What type of assets does the company has to pledge or to use it as a security? Conditions mean, what are the economic conditions? How are the borrowing economy performing, and how are the expected returns and uh, I mean overall economic conditions? This is what we need to see. Now in this example, we need to see the change in the policy, mean credit policy. If the company changes the credit policy from existing to another, what will happen? So let's say your company sells its product with a 1% discount to customers who pay cash immediately. Okay, so 1% discount is for those who pay immediately, not for 10 days, not for 15 days, immediately, right? Otherwise, the full price is due within 30 days. So this is what it is like. So when the purchase is going to be made here, so 50%, 1% discount, 1% discount will be given on the same day of purchase, and the rest is, and the total period is 30 days. Okay. Half of your customer take advantages of the discount. So whatever are the sales, half will be paid here. And you are considering dropping the discount so that your new terms would just be net 30. So your new policy is no need to give any discount, just net 30. Okay. Of course, when you are dropping the discount, you are expecting your sales to drop. So this will happen. Okay. If you do that, you expect to lose some customer who are willing to pay the discounted price, but the rest will simply switch to taking the full 30 days to pay. Okay, the rest are thinking that we are okay with the policy, new policy. Altogether, you estimate that you will sell 20 fewer units per month. Okay, so less than 20 are the units that you are expecting to lose. Okay, and how many units? 500 units. 500 units you are currently selling with the existing policy, but with the new policy you will sell 480. Your variable cost per unit is $60 and the price per unit is 100. Okay, so this is cost, this is price. If your required return is 1% per month, should you switch your new policy? Okay, so it means that all the information is given in a month terms. Okay, first of all, we need to see now and 30 days. So this is 0 and this is 30 days. Okay, what is happening? So what is your total production? Total production is 500 units and the price of each unit is how much? 60. So what is your total cost? That is 30,000. With this is existing policy, remember, existing policy. Okay, so what is happening? 30 days, 30,000 is your cost. If 500 multiplied by cost per unit, so this is this one. Okay, and you know that when with the existing policy, whatever is the sale, you get 50% at a discounted price. Okay, so 500 units are sold, 50% of 500 is 250. So but the price is discounted price. Instead of 100 you will receive 99 per piece. So what is the inflow? That is 24,750. So this is your inflow or total cash flow. It could be either outflow or inflow, right? So this is your total flow, negative now at time 0. After 30 days, what will happen? When we will approach 30 days, the remaining customer will pay us total because they are not using discount. So 100 per price and 250, you are going to get 25,000. Okay, but your next round has also started. Mean you will also produce. You're also going to do, because your total duration is 30 days. So it means when 30 days over, new sales will start. Okay, so product produced next of 500 units at a piece 60. So you are going to sell, you are going to produce. So what is the total cost? 30,000. But at the same time, you will get the discount. It's the same price, the same part, this one. So that is 24,750. Okay, so the answer is 25,000 minus 525. Now, if you see, you don't need to be worried. We need to calculate the net flow. Net flow is 25,000, and the difference of these two is 5250. In other words, the net flow is 19750. So now you have a timeline of now and after 30 days. Now you're at time zero. This is your uh, total flow, net flow, or this is at time 30. This is your net flow. Okay, so you have now and 30 days, 0 and at 30 days. Okay, so we need to calculate the NPV. Now the company is switching to 100% 30 net 30 policy, mean no discounts. What will happen? You are expecting that when you are going to give new policy, your sale will drop from 500 to 480, 20 less units, right? And the cost of each unit is 60. So this is your cost. So at time zero, this is your net flow. Net flow -8 times 0. So customer pay for next 480 at 100 a piece after 30 days. Okay, so this is your total revenue after 30 days. But at the same time, the next round has also started. So the cost will also, you also need to make this cost. So negative 28,800. So whatever is the difference, you write the difference here. Okay, so whatever is the difference, we will write. Now we just need to calculate the NPV. NPV is initial cash flow plus present value of cash inflow. Okay, since the company is aimed for a perpetual life, right? Perpetual life. This is not for 2 years or 3 years. So that is why we are not going to do present value of annuity formula. So simply we are using PV is equal to CF divided by R. Okay, because perpetual company has a perpetual life. So this is CF. I don't know why they have written separately. So it should be 19,750. 19,750. It is the same thing, but I'm just trying to write. And your answer will be this one. Similarly, you can also do it for the new policy. The answer is lower than your existing policy. Okay, so what is the decision? Decision is not to follow this policy because your net present value is lower, is higher in your existing policy compared to the new policy. So you will make a loss of this much if you adopt to a new policy. Now we are going to see payable management. There are two methods where we can see whether we are managing payables correctly or not. Number one is we need to determine the account payable days outstanding. So it means how many days do we take to uh, pay back our liabilities. Another one is stretching the account payable. Okay, we need to extend the payment period. So let's say first one, we need to determine firms should monitor their account payables to ensure that they are making their payments at an optimal time. So it means that if let's say the total duration period, you are the customer now, right? If you're paying it on 14th day or 13th day, so it means you are paying early, no need to do that, right? And if you're paying too late, so it could spoil your relationship with the supplier. Okay, so for instance, if the account payable outstanding is 40 days and terms are 210 net 30, the firm can conclude that it generally pays late. Okay, so it means that if this is the policy, okay, this is the policy 10 and 30, but the company is going to pay in day 40, so it means that company is paying late, right? The firm can conclude that it generally pays late and may be risking the supplier difficulties. Of course, this is not good for the supplier. Conversely, if the company pays payable days outstanding is 25 days, if let's say if it pays in 25 days, the firm has not taken the full advantage of the discount, as well as it is also paying too early. So no need to do that. If it is discount period is 10 days, your company should try to pay on 10 if it wants to take the discount, or if it is not taking the discount, then no need to pay early, pay it on 30th day. Okay, stretching the account payable. Some firms ignore the payment due period, that is 30 in our example, and pay the amount out later. In practice, refer to as stretching the accounts payable. Given terms of 2, 10, 30 in this example, for example, a firm may choose not to pay the amount out until 44 days he have passed. So it means maybe he is going to pay on 45th day. So it means he is stretching that. That is not good, but it is helpful for the company, but not for the supplier. So now let's take an example. Our company has an average account payable balance of 250,000. Its average cost of goods sold is 14,000. Okay, and it receives terms of 250 net 40 from suppliers. The company chooses to forego the discount. Is the firm managing its account payable well? So it means the company is not interested in the discount period. We need to see whether the company is doing well or not. Okay, so um, given company's balance and its cost of goods sold, we can compute the average number of days it takes to pay its vendors by dividing the average balance by the daily cost. Given the terms from its supplier, the company should either be paying on 15th day to get the discount, or on the 14th day. Okay, so this is an ideal situation, on 15th day or on 40th day. So if any period other than this period, it means that there is a problem. Okay, so company's account payable day outstanding is, we need to calculate that. So that is account payable days outstanding, payable days outstanding is equal to payable divided by CGS. Okay, so that is 17.9 days. So company's current payables are being paid on 17.9th day, or in other words, just 18th day. So it means they are being paid here 18th day. So this is not good because the company is not taking the 2% discount that was offered to 15, right? So it means this is not getting the benefit of the discount, as well as the company is paying too early than its scheduled or the credit period. So company should pay either on 15th day or on 40th day. So this is just we need to see, and next we need to see the extended period. Okay, so what is the effective annual cost of the credit terms of 1/15 net 40 if the company stretches the accounts payable to 60 days? So this is 15, 45 is the original one, 40 is the original, but the company is going to pay in 60 day. I mean, this is not good, but we need to see what will happen. Okay, so the interest, if the company pays on 15th day and the purchase is $100, so company can pay 99 on 15th day and can save $1. Same example, right? $1. So originally this saving was for 40 days. Sorry, not 40 days, 25 days. Okay, so this $1 is the saving that you are going to make for 25 days. But since the company is not paying on 40th day, company is saving $1 for the company is using that 99 funds for how many days? For remaining 45 days. Okay, I repeat it again. So if the company wants to take the benefit of discount, so company take a discount of $1. Okay, so company can pay it and that's all. Okay, but the company is not interested in this saving. The company wants to use this 99 for remaining 45 days, not 25 days, even for 45 days. So now we need to calculate its effective annual cost. So now effective annual cost will be with respect to these 45 days. We need to compare these 45 days with this 25 days. Okay, so with the 25 days we already calculated. With the 25 days, you remember in the previous part we had calculated that 1.0 1.0101 14.6 minus 1, that was 15.8%. This is we had already calculated, but instead of using 25 days, now we need to calculate. Now we need to use 45 days. Okay, so how to do that? This part will remain the same. So it has 45 days. So how many times we observe 45 days in a year is 88.11 times. Okay, so we repeat the process and the answer is 88.45. So if you say paying on time specified to 25 credit terms, there are 365 or 14.6 25 days period in a year. Thus, if the firm pays on 40th day, it is 15.8. By stretching its payable, the firm substantially reduces its effective cost of credit. So if you see, so if the company pays on 40th day, we are talking about with respect to payables, right? So if the company pays on 40th day, so effective annual cost is 15.8. But if the company is stretching, the cost will reduce from 15.8% to 8.49%. Remember that we are now talking about with respect to cost. Now, just few slides that are more descriptive. So we need to see inventory management. So it means if we are holding the inventory, what are the benefits? The benefits are that we can minimize the risk that a firm will not be able to obtain an input. It needs a production and helps avoid stock out. In other words, keeping the higher level of working capital will help the company to meet any sudden changes in the demand or or any liability, right? So it can help us. But keeping the higher level of inventory means also keeping cost of holding cost means we will have to pay higher acquisition cost because we are buying it on in a bulk, ordering cost, and then carrying cost. So these costs will be higher if we are holding higher level of inventory. So these are just small uh, points that you need to remember. And the last one is cash management. Cash management also does not require any calculation in this chapter. We will discuss three motives. When a company wants to keep higher level of cash, cash is also part of working capital, remember. Okay, so we have discussed account receivable, payables, inventory, and now cash. So there are three motives for holding the higher level of cash. Number one is the transaction balance. Transaction balance mean we need to meet day-to-day needs. Mean if you want to buy any asset, current assets, or any operational activities, we need this. We need the cash. Okay. The examples may include, for instance, the salaries or wages, interest payments. So these are some example of transaction motives. In the precautionary motive, the company needs to keep higher level of cash to compensate for the uncertainty associated with its cash flows. Okay, so if you see in the course of the life of the company also experiences some uncertainties like labor strikes, lockouts, change in demand, etc. To fulfill that shock, any shock in those elements may need some cash. So that's why in order to be safe, the companies, they need higher level of cash. Precaution mean to reduce your risk. Okay. And the last one is compensating balance. It means to satisfy bank requirements. It includes, for instance, a firm may require, maybe a bank may require a firm to hold a certain level of cash as a compensating balance. And normally the compensation balance of cash or cash is typically deposited in accounts that earn either little or maybe no interest. So if you say this arrangement is similar to a bank offering individuals fee checking as long as their balance do not fall below a certain level. So say, let's say for instance 1 million, especially the customer has if has maybe if 1 million cash that cannot use unless she is willing to pay a service charge. Similarly, the cash that the firm has tied up to meet a compensating balance. So this is a balance that the company needs to actually keep in the bank to compensate any shortfall. So this is the main thing. Okay. So I would encourage you to see the example of the transaction balance, precautionary balance, or compensating balance. So these are some of the motives, some of the reasons that the companies they hold higher level of cash. Thank you.